Good afternoon, everybody. Waiting on NVIDIA. Let me do the disclosure. I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. I've re-entered into a little bit of pins on the dip. I also re-entered Microsoft, but I closed it by the end of the day. I re-entered Shop, but I closed it by the end of the day. I traded a little bit of that crazy ZI thing today, made a couple bucks. Traded some Qs, traded some IWMs. Actually traded a decent amount of names that I closed out intraday today. But especially considering that there really wasn't too much going on. It's an inside day for the SPYs. But anyway, we're waiting for NVIDIA to come out. It's down 4.5% on the print, into the print off of the Micron news earlier today that came out pre-market. That kind of sunk this whole market a little bit. Micron got smoked on a little bit of a warning that it put out. So we're waiting on that. Cisco reported. Cisco looks like it had a decent little beat. It beat EPS by 2 cents. Looks like they beat on revenue and raised guidance. So Cisco trading well after hours. What's this GLBE doing? Down, smoked. Down 20%. Global E Online. I don't know what this company is, but it's definitely come on the radar a couple of times. Looks like they missed on earnings by 10 cents. Revenue beat. I bet the guidance is trash. Yeah, guidance is trash. Guidance is a solid miss on that GLB, and they're punishing it for it. Sonos just announced a secondary, so I know. Kind of got smoked on that. Sonos got smoked a little bit today, but it's up a little bit after hours on the $100 million secondary news. Yep. Tesla board member James Murdoch, Elon Musk identified as a potential successor in the last few months. Anyway, we're waiting on NVIDIA still. So I'm going to keep an eye on that out of the corner of my eye while we review the market. So inside day for the SPYs today. Qs and IWM are weaker. Qs broke the previous day's low, still off the ADMA by a good bit, and the IWM was weakest. So on a percentage basis here, the S&P closed down about 0.5%. The Nasdaq was down a little over 1%, and the IWM got smoked. It's down 1.65%. So we continue to see some of that relative weakness that's coming out of the IWM, which I had mentioned it does make sense to see a little bit of mean reversion with how the IWM traded versus how the Qs have traded. But the Dow, which has been the biggest outlier on the upside, it's actually still green today. Is Cisco a Dow component? I think it is, right? That might be helping helping the Dow out further right now. So anyway, back over to the SPYs. Inside day. The game plan in the morning meeting today was I really felt that one more day of patience is required. You did have your 5 moving average, which I don't really look at on my own charts, but I know Pat looks at that a little bit. It's good, like momentum moving average. Had kind of caught up to this base of price action, but the ADMA is not there yet. This is day 3 of kind of rest at this point. Day 3 of corrective price action, but it's after just such a massive 2-day move. But the more we go sideways up here, technically that's bullish. So we've kind of created a little bit of a base of support between, like, I'm going to call it 393.61 and 394.49. EDMA is not quite there yet. ADMA is at 391.40. So, you know, we're still extended by less than $5 at this point. And this moving average is slowly catching up here, and that's exactly what we need. That's exactly what we need, corrective price action. So maybe tomorrow I actually love that the SPYs gave an inside day today. I wish that the Qs and the IWM had as well, because this sets us up. The inside day sets us up for a trade setup on either side of the market. Inside and up, tomorrow, this moving average is catching up a little bit. Then you know the bull market is still in place. Inside and down, we could be looking for deeper corrective price action to the 80 EMA or even to the space between the 8 and 21 EMA. It wouldn't be the worst thing in the world if the market retested 390. I know it's $6 down. Bulls don't necessarily want to see that. They want to see the strength and momentum to stay in place. But you could have an inside and down in the SPYs that leads to a retest at 390 and a little bit of a deeper pivot with further corrective price action through time and price. So that, I think, is the biggest thing to be waiting for right now, and that's our setup for tomorrow. It's going to be long above the inside day high, short below the inside day low. Qs did not do that. Qs are also still a little bit extended by, $5 or so. That 80 EMA is slowly catching up after that really big move and some outperformance from tech and some of these mega tech names. And again, the IWM being a little bit weaker here on these last few days, and especially weaker today, actually clipped the 80 EMA. So this has fully corrected the upside extension that it had post CPI through price and time. It's always notable when you get those fast moves how the space between the 8 and 21 begins to widen, so that lower band of equilibrium becomes a little bit further away. But each day we go sideways here, we're slowly catching up. And again, I love that the SPY gave an inside day today, even if it meant that the intraday price action was extremely boring. I love that we got the inside day today because it potentially sets us up for new trades tomorrow. So that's that. As far as individual names go, we identified I always want to be excited in the morning meeting. I always want to be like, hey, today's the day. There's going to be a ton of opportunity out there. And unfortunately, it's just not always that way. There was a lot of opportunity in those first 2 days, and these last 3 days have just been much, much trickier as the market has corrected. But the key is to recognize that. It's really important not to force trades. And I probably overtraded a little bit today, to be honest. I shouldn't have done that. It's really important not to force trades when the market's not really kind of giving you the setup that, there was just no thought process in my mind today at any point, even as I was putting on some counter trend trades like the IWM and the Qs, and we got a little bit extended to the downside in the small time frames. There was really no thought process in my mind that I really have the market on my side, just because we're still kind of correcting through time and price here. You couldn't really count on the market at all. So it was another day for less is more. Let the market set up. Let the continuation potentially come in, and that's pretty much it. There's nothing really else to talk about with the market. Are we still waiting on NVIDIA? What time is this NVIDIA supposed to come out? It's still not out yet. So that is the market. I guess as far as individual names go today, how did some of those earnings names end up playing out? The Target got bought back a little bit, which is notable. TJX had a monster day that kind of goes back to what we've been talking about Target's earnings being a little bit weaker because people are spending more money at cheaper places, cheaper retail stores like Walmart and TJX. So that Walmart earnings report yesterday was phenomenal. Target pretty good. Lowe's ended up trading okay today on a decent report. We had mentioned the cryptocurrency stuff a little bit. Coinbase is a potential short. I actually think that this was the best trade of the day. I missed it. I was late on the call out. I don't know if anybody caught it. We had mentioned $53 as an important spot to potentially sell short through on coin. First bar was a little bit crazy, but it gives you this really nice inside 5 right at that key $53 level. So the inside 5 and down here on this coin, probably the best trade setup of the day, and it was something that was in play just with what was going on with we saw that the Genesis news came out this morning that their lending unit was halting redemptions, so just potentially another ball to drop. Looks like NVIDIA's out. NVIDIA just had a quick downtick there. Not seeing the numbers yet. Upticked back up. 420. There we go. It's 420 right now. NVIDIA trading higher now. A little bit. I'm still not seeing the numbers. Anybody got them? Price action looks decent, but I'm not buying anything without seeing the numbers. There we go. EPS looks like a huge miss. 58 cents versus estimates of 70 cents. Not the most important number anymore. EPS guidance is more important. Even revenue, I think, is more important. Revenue beat. So when I see an EPS number that misses that much with revenue beating, I assume that there's like a one-off charge or something that's bringing down that that EPS number. Stock's down, ticking back a little bit. NVIDIA's gaming revenue is a solid beat. Revenue's a beat. Gaming revenue's a beat. EPS is a miss. Stock is trading up about $3 or so from where it closed. NVIDIA, okay. NVIDIA sees Q4 revenue at $6 billion plus or minus 2% at an estimate. So that's a slight miss, plus or minus 2%. It's kind of a wide range there, but that sounds like a little bit of a miss on revenue expectations. But the stock's trading decently on it, and it's a good thing. That's what we need. Sorry, I still got a chart up here that's not giving us any data. There's the intraday. You can see there was that very, very quick downtick, and then they've ripped this higher here a little bit. Fairly muted move so far. It's after this NVIDIA was able to kind of come down into the 80 MA on that initial downtick on the daily chart, working its way back up. So that's solid. AMD moving at all in sympathy? Yeah, AMD's up a little bit in sympathy. Okay, so we'll continue to monitor the NVIDIA situation because it's become such an important stock for the market. But anyway, you kind of was just reviewing, you know, that Coinbase traded a little bit with the inside 5 and down, and that was something that was in play that we were looking at and potentially paying attention to. BITI was something we chatted about for a potential trade there alongside it. I briefly got involved in that BITI, and I just did not like the liquidity on how the thing traded, so I just basically just didn't get involved in it. Coin was probably the trade of the day, but I totally missed that. And that was pretty much it. You know, there just wasn't much else to do. I thought that maybe the XLF could be relatively strong again today because yesterday's tail kind of clipped that 80 MA, and it was not. So there ended up being kind of nothing to do there. Energy had a weaker day today. Energy's pulling back. This XLE pulling back to the 80 MA on the daily chart. I think that's a good thing, actually. It helps set it up a little bit. In big tech land, Google was nice and relatively strong. Amazon was relatively weak. Apple and Microsoft were somewhere in the middle. You got an inside day today from Microsoft. So that's all stuff that we can continue to pay attention to for tomorrow. And I guess that's really all I got. I don't really have much for you guys today just because of how this market was kind of set up. I guess we can look at an intraday here real quick. You can see the gap down in the market. We filled that gap. SPY is just very, very boring inside day. Qs and IWM had a little bit more action because they were weaker. Qs trended down here in the beginning of the day. Started to put in this kind of reversal pattern. I actually got decently excited about the Qs here at 12:45 when they were kind of breaking this intraday resistance. I thought that could lead to new highs. Maybe we would go into one of those upside grinds like we talked about was a possibility, but it did not happen. And the IWM was just much weaker. Much weaker. So yeah, not really too much even to analyze there. So I guess I'll just turn it over to you guys for questions. Scrolling up here in the VTF to see if I missed anything. Looks like first is from Mark. Sorry, got something stuck in my throat. Mark on Shopify. So you took it at the close yesterday. Okay. I really generally prefer for people to have an intraday cushion into a swing because I totally like what you were looking at here with the daily chart. But when you don't have that cushion, the whole market could just gap up. This thing could gap up to $41. This thing could gap up to $41 and still not breach the stop loss, which I think should be $41.73. And then before I read everything that you wrote here, the other thing that I would just mention is it seemed like you actually, let me read your question first. So you took it at the close yesterday at approximately $40.10. You did it with weekly puts. Since I was in puts, I was looking for more of a binary move and to hold with momentum. I sold some at 931 to lock in and cover my risk. Okay, fine. I sold the remaining at 932 and the stock started to move up. Both sells were when the stock was around 39. I had puts. So early here. If the stock had not moved up so aggressively in the open, I would have held it longer. Any feedback is appreciated for a 40% profit. Yeah, so I just don't like the risk reward of how quickly you liquidated the entirety of the position. The first cover makes sense. You know, it's gapping down in your favor and you want to take a little bit off. It makes sense. I just think that, like I was just saying, the market could have easily gapped up this morning. It gapped down, but it could have easily gapped up. If the market gapped up, this stock could have opened up today at $40.80, $41, $41.20, something like that. And you know, for me, and I'm not sure because you're doing it with options, if you're planning on just kind of holding them because you know exactly how much you're risking on the position because you know your inputs there. But to trade it properly, I think that the right stop loss actually would be yesterday's high if you were going to trade the technicals on here. So you know, if you're shorting into the close like that, you know your price is $40.10. I think that you're really risking up to this 41.70. Either that, or you're just fully risking, you know, what you paid for the contracts. So given that this could have easily gapped to, you know, $41 today if the whole market gapped up, which certainly could have happened. I just don't like the risk reward of totally liquidating the position here. And again, it's weekly, so maybe you're dealing with some time decay or something like that also, which makes you want to get out of the position a little bit more quickly. This is also why I don't like to trade options. But I just think that, you know, you get this big gap down that's in your favor. The way that I look at stocks, you got this big gap here. This ADMA is not caught up to the price action yet. This is going to have a lot of volatility off the open. But as far as the daily chart goes, the daily chart tells you as you're putting that trade on that you really should be having a big picture target number one of the ADMA on the daily chart, which is about 37 bucks. So I just think that I just don't like the risk reward on kind of how you traded it, because you could have this thing entirely gap against you. You're taking that overnight risk. If you're taking overnight risk, you really want to make sure you're getting reward that is bigger than just a gap, because getting that gap in your favor, getting that gap against you, even though you've got the bearish daily candle from yesterday, I think it's like almost a 50-50 chance probably, because the market's been a little bit strong. We've had some time correction. You know, we could have had the gap up. So again, the first cover, taking some off right away because that gap is in your favor. You know, making sure that your risk is covered, things like that. I'm totally with it, but you missed out on the rest of this reward, and this reward could even be further than that. You know, for myself, because I remember we talked about CHOP, I think in the morning meeting, that the same targets that I would have on a short trade are where I would personally be looking to start getting back long. So for myself, I bought $38 today. I bought $38 about into this pullback. I remember being annoyed because I was bid 38.01. This low here was $38.02. And then I ended up getting involved in this area, in the $38 area, and kind of catching this bounce. And I just kind of made 50 cents for myself and was out of the position because that was my game plan. So that would be my only thought process, is that I think that you potentially left reward on the table in the way you exited it, especially since you got a cover there already. You know, you're probably a little bit more in a win-win situation. You know, you're looking at like a 1 minute chart that the stock is like trading up against, or maybe it wasn't a 1 minute chart, maybe you're looking at a 5 minute chart, but just in the first 1 to 2 minutes of the day here. And you're seeing it begin to kind of rip against you, but there's so much extension here, you're going to get a lot of volatility. It should actually initially bounce back. And what you want to see from the stock is exactly what it did. It created a pivot high somewhere, let this ADMA catch up to that, then you could have used the day high as more or less a stop loss, and then see if you go into a pattern of lower highs and lower lows. Stock eventually works its way down to 38, but even 38 I don't think would be like profit target number one. I think profit target number one, big picture on this thing, and I think you have to be thinking big picture because it's a swing position, is 37. So that would kind of be my feedback on it. I just think that what you did there is a little bit reward limiting. if that makes sense. Yeah, I think that you overread the initial move up. That gap down is so big, you're gonna get a lot of volatility off of that open, and the stock might bounce back a little bit. It's a common gap down. It could even fill the gap there. You want to see how the thing pivots, but taking some off for sure. You got a nice gap down to $39 or whatever. Put some in your pocket to make sure that risk is covered, to make sure you're comfortable on it no matter what. It's the second cover, the second sale that I take a little bit more issue with, because I view that to be less about making money at that point and actually more about not putting yourself in the position to maximize the winner. Nice. Yeah, so 38.01. Yeah, that's exactly where I was looking to enter. Yeah, so it's tricky on swings. You're saying here that you need a little help with the stops. It's tricky on swings. For me, when I commit to keeping a position overnight, I commit to using daily chart stops. I'll either use my original stop if it started as a day trade today and I'm keeping it tonight. I'll use that original stop tomorrow. But beyond that, so maybe that original stop is an intraday stop is what I'm trying to get across. But beyond that, I'm committing to using daily charts because I just don't think that the risk becomes worth the reward of keeping a position overnight to then trade it on like a 5-minute chart. And that's also why I really do prefer to have those stronger profit cushions going into the swing. But I think that holding positions overnight and swing trading on positions after they're in the money is one of the best ways actually to get overwhelming reward for the risk that you put on. I've said it here in the VTF plenty of times in the past. The longer that I've been trading, the longer my hold time has become. And that's actually a good thing because generally what I'm doing is I've got positions that are in the money and I'm looking to hold them for as long as I physically possibly can. It's a little bit different on a counter trend trade than a with trend trade. On a counter trend trade like this, overall, you got to recognize that Shopify's chart has gotten a little bit bullish. It just got ahead of itself. So you're looking for kind of that retracement. So on a counter trend trade, it makes more sense to be more aggressive on the profit taking at specific profit targets. But especially if I'm with the trend on something, I for the most part want to see what this thing can do. I want to let it potentially give those bigger pullbacks, and then I can raise my stop. Like if you're long from I don't know somewhere in the 20s, for example, as a swing position, my stop would be here still. It'd be here still. And then what I'd be looking for is this to become the new pivot low that leads to a new high where I can then raise my stop to this. And I have no problem, as crazy as it might sound, I got no problem potentially giving stock back from $40 to this low because it's all open reward. And the open reward is where I want to be greedy. I probably would never come in and buy stock in Shopify at $40 and give it down to $30. But if I'm in it from 25 and it's at 40, I might give it back to $30. But I'm giving it back to $30 because this thing could trend up to 60. And that risk reward becomes very worth it. Or it could trend up to, again, some unlimited amount. And you might be like, wow, $60. Like, you're a little crazy there, Derrick. But, this stock was a $180 stock. And I've got other examples of times in my career where I've bought bases like this that have led to trends where I've been in the position for, a very long period of time, and it just continues to move in my favor over time. So again, on the overnight, because of the risk, I just don't think of it. If you're not going to use a daily chart stop on an overnight position, it's not worth the risk of keeping it overnight, and you're better off just closing it out into the close. But I certainly get the trade. You're trading a daily chart candle, so I get that. But just you never know how the market's going to gap. You never know what news can come out for the stock either. I talk about the story sometimes about. I was trading this company Qihoo 360. I don't know if anybody remembers that. It's a Chinese company. They eventually, I think, went private or something, so they're no longer listed. And I like crushed it one day in that Qihoo. Like there was news in the stock or whatever, and I caught like an intraday 15% move on it. Like totally crushed it. I was so happy with myself that night. I kept 15% of my position overnight after such a big move as a swing, and then that night they announced some sort of accounting scandal, and the stock gapped down like 18% or something like that. And I was like so frustrated the next morning. Like, oh my God, I just crushed this. I caught this 15% move in Chiyu, and now it just gapped down 18%. And there I was holding stock in a position that's gapping 18% against me. And as I'm hitting out of the position, I still made money in it because of how big the profit cushion was and how small, how much less stock I had of my original core position on what I sold. So, hope that helps. Hope that helps, Mark, for sure. From Tom. Can you explain what you are looking for when price is too far extended from the 8 and 21 EMA? How much is too much? Sure, great question. Great question. So I use the 8 and 21 EMA as the space that I consider to be technical equilibrium for any stock or any market that I'm looking at, and that applies on any time frame. It could be a daily chart, it could be a 5-minute chart. It applies for any stock, it applies for any market. So the space between the 8 and 21 EMA, the 8 EMA being my blue line, the 21 EMA being my red line, the space between them, and it's always going to be an area, is the equilibrium, the technical equilibrium area for that stock. And that's just kind of represented by these moving averages and how they've moved over time. So when a stock has a quick move in a short period of time, it's usually momentum, that stock will get extended away from the equilibrium zone. Like you can see that here with almost anything you type up. Between the CPI day, whether we're looking at the SPYs or we're still Shopify up, between the CPI day and the day after it, just a really, really big 2-day move. So with Shopify as an example, at highs on the Friday, the day after the CPI, Shopify is trading at almost $41 with the ADMA being at $34.59. So I'm looking at a stock here, a $40 stock that is extended by, let's just call it $6, $6.50, $6. So really the right way to think about this, and I don't always do it this way because honestly, because my mental math on percentages should be a little bit better. The right way to really think about it would always be to think about degrees of extension, and the one way that you could do that is just by what percent is it extended by. So that ADMA in a strong stock is always going to be the upper band of equilibrium. The ADMA in a weak stock, like Shopify back in September or October here, is always going to be the lower band of equilibrium. So what happens over time is that even when momentum comes in that creates extension cannot last forever. It can last for much longer than we might think it will, but it can't last forever. Eventually an extended stock needs to correct through time or through price. So the question on how much extension is too much, it's a very subjective question to the type of stock that you're looking at and the time frame that you're looking at, and also the events that are occurring around it. Because typically when an extended stock becomes even more extended, and you might be looking at it and you go, oh my God, this thing's way extended, it's way too extended, it has to come back down. It can always become even more extended, especially when there is news or volume. One of my favorite sayings in trading is that a stock or a market that is irrational can always, a stock or a market can remain irrational for longer than you can remain solvent. So you should never just look at something that's extended and say, I'm going to go the other side because it's too extended. We do want to pay attention to that extension, because when we're looking at something that is air quotes like too extended, it's hitting like those extreme areas, we still want to look for an actual signal to go the opposite side. And then we can short, if it's a short, we can short on the way down versus a level, so that way you've got that specific stop loss and you can really measure what your risk is. And then again, how much is too much depends on time frame and the type of stock, depends on the stock's beta. So it's going to tend to be that like Coca-Cola or Procter & Gamble, it's going to be much less likely to see them become, let's just say 10% extended from the ADMA, because again percentages would really be the right way to look at it. It'd be much less likely to see that get 10% extended away from the moving averages than it would be for like a highly speculative like marijuana stock that has some news on regulation that comes out, and the stock rips higher and has this fast move, and there's a really big short squeeze. So the question of how much extension is too much extension, it definitely depends on the product that you're looking at, depends on the time frame that you're looking at. You know, I do have some kind of key, and I can kind of just eyeball it. And again, there's degrees of extension is the other thing to pay attention to. So technically, if you want to be super specific about it, a stock that's trading 1 cent above the ADMA is extended by 1 cent. That's basically nothing. Like, for our actual purposes, we would say that that's not extended at all. And, you know, then maybe that same stock becomes extended by $5. And again, I'm using dollars and not percentages. But now it is more extended than it was, right? Or it could be now extended by $10, and it's even more extended than it was. So really the right way to do it, which I don't do it, I really don't do it this way, and I probably should, would be to be measuring the percentage of extension from the ADMA. For myself, and probably the reason why I don't do it and why that way and why it works for me, is because I understand this type of stocks that I'm trading, and I understand that, like, Shopify has the ability to get more extended than Apple does generally, and I can just kind of measure that extension. I can kind of eyeball it, and I'm just going to have that general idea of that degree of extension. And then you want to pay attention to it. My favorite example of an extended stock becoming more and more extended, and why a market can remain irrational for longer than you can remain solvent, is JKS, Jinko Solar, back in 2020. If you look at this chart, and I'll zoom in here, if you look at this move, this was completely insane. You had a $23 stock here. Really, stock was trading at 19, but you know, it's just whatever. $23 stock has a big 3-day move, and it's at $34. And you're like, oh my God, look how extended this is. It's a $30 stock. It just went up 10 days in $10 in 3 days. Sure, you want to say hello to everybody?
I always love to say hello. Is your face on?
Here's the camera right here. Yeah, that's us over there.
Ladies and gentlemen. Barcley Center.
Are you?
Michigan basketball game.
Basketball game? Good luck.
All right. Good luck, everybody.
Who are they playing?
Pitt.
Okay.
In the Classic.
I know nothing about college sports at all, but
so
we'll root for you.
Tell everybody I said hello. Best of luck. Market's looking good these days.
Yep. So anyway, you got this stock here. It's just gave a $10 move in 3 days, and you're like, oh my God, this thing is so extended. It's trading at $34. The ADMA is at 26. That's a good amount on a percentage basis, and you're like, oh, I'm gonna short it because it's too extended. Even though there's no signal, there's no topping tail, right? We want a signal. There's no signal that comes in, and guess what? Inside and up, it takes 1 day of rest, and then 1, 2, 3, 4, 5, 6, 7 straight up days. And then you're like, oh my God, this is insane. It was just a $23 stock. Now it's a $48 stock. The stock traded to $48.50, and the ADMA is at $40. It's just extended by $8 in a $40 stock. Like, this is insane. It's got to pull back. And it gives 1 more day of rest, and then bam, a massive 3-day move. And then 2 days of rest, and then 5 huge up days. Next thing you know, the stock doesn't top out till $90. And it's extended at highs here, puts in a high of $90 that day, with the ADMA down at 70. It's extended by $20, So it just insane of an extended stock becoming more and more extended. So we don't want to just come out and look at this thing here at $34 and say, I'm shorting it, it's too extended, and have no stop loss. We always want to make sure that we have that signal, because the stock that's extended can always become more extended. But what does that 8 and 21 EMA tell you? I'll tell you guys something for sure. We could look at this stock, and you could say to yourself, with the gift of hindsight, on September 23rd, when it closed at $33.46, how many people here would love to be able to go back in time and buy this stock at $33.40 and capture this entire move? I mean, sure, if you had this perfect gift of hindsight, you knew exactly what was going to happen, all of us. But this is not going to ever pay you consistently to trade this way. The stock becoming super extended generally means that you don't want to buy it. And I don't care that the stock just went from $34 to $90 before it eventually tops out. I know that in the long run, if I'm buying on the close on this day, I am not going to make money. My risk reward is terrible here. I don't care that in one stock in a million that this thing went through the roof afterwards. What this is telling me when I have this degree of extension is I don't want to buy. It's too extended. And that, by the way, the same principle is why we haven't wanted to buy the market for the last 3 days. Every morning I'm coming in and I'm like, guys, the market's like really strong. People aren't positioned properly. Like, there's reason to think that we could have a rally into the end of the year here, but I don't want to do any new buying. Why don't I want to do any buying? Because I know my risk reward stinks because of the degree of extension that we had. And with the market, Tom, with the SPYs and Qs, what we've seen very consistently this year is every time the market becomes $10 plus away from the ADMA, either on the upside or on the downside, that the market can't give any continuation. Doesn't necessarily mean short. It just means that if you don't want to be buying SPY 400 on, you know, the 14th, on two days ago, you don't want to be buying SPY 400 with the ADMA at 387. Did we get any continuation here? No, we didn't get any continuation here. It's so difficult. And is there a circumstance where the entire market could do what Jinko Solar did in the other example? Probably not, because it's an ETF that's, you know, representing the entire market. But it could become more than $10 extended on a one-off occasion if, you know, really good news hits and everybody is offside, even though it tends to have been the stopping point this year. So it doesn't necessarily mean that I want to short, and that's kind of what I've been trying to get across to you guys. Like, the short here is hard. This market's super strong. You could look for that counter trend short, but I also can't buy. I would rather be long than short this chart. I would rather be long than short this chart right now. But I don't want to buy $10 of extension in the SPYs because we've just consistently seen that you can't get any continuation. Look at the risk reward. If you bought $400 a couple days ago, the ADMA is at 387. The last like pivot point, if you even want to call that, it's really more like an ignition low, is, you know, 385.64. If you're a swing trader and you trade daily chart patterns, which, as you guys know, that's not how I do it. I trade daily chart patterns, but with small time frame risk, not with daily chart risk when I can help it, unless it's a feeler. But if you traded daily chart risk, daily chart patterns, and you bought SPY 400 on this day, you got to give this thing all the way down to 385.64. I got to come in and risk $15 in this spot when my probability of getting continuation becomes extremely low because of that degree of extension. So it's just not putting yourself in a good spot. And therefore, even though I'm trading smaller time frames, I'm looking for the 5-minute chart on entry and risk and things like that, I know that my reward is capped when this thing's trading at $400 yesterday or the day before yesterday, because that degree of extension is still there. So that's why that becomes so important. And that's also why I keep saying to you guys, like, all right, we're being patient here. The more sideways price action we get, this ADMA catches up. Every day that goes by where the market moves sideways, there's a higher probability of upside continuation. Tomorrow, there will be a higher probability of upside continuation than there was today. And today, there was a higher probability of upside continuation than there was yesterday. Excluding for the moment that there was a news event yesterday that maybe actually could have made yesterday a little bit. That's an additional piece of information that we have to factor into the puzzle. But just talking about the extension factor for a minute, tomorrow has a higher probability of continuation than today did, and today had a higher probability of continuation than yesterday did. So that is how I'm looking at it, how I'm thinking about it, and how much extension is, again, air quotes, like too much, because that's going to be very relative. So appreciate the question, Tom. From Rich, so Champ, percentage-wise, approximately how much open P&L did you have to give back to gain your JNUG reward? Also enjoyed your lightning round on YouTube for the Derrick the Trader YouTube channel. Yeah, so I started to, if you guys didn't see, they've been filming some cool little just like fun videos with me over here at the office. So we did this. I didn't even know what questions they were gonna ask me. It was kind of like rapid fire. So we did this little like 26 questions with me and a couple other little videos that I've done recently. If you haven't already subscribed to this, please subscribe. I'm trying to build this one out. Make sure you give the thumbs up on the videos so we can get some more eyes to come in on them. I appreciate all that stuff. The JNUG trade. The JNUG trade was interesting because when I got into the trade, I got somewhere towards the end of the trade, they did a crazy reverse split, and I don't remember what price the thing was trading at. Where was that? Yeah, this was like insane related to this thing. This product like blew up during COVID. I can't remember what price this was split adjusted. Yeah, look at this. This thing went to like 180 something dollars on that bounce back, and it hasn't seen that price since. Surely this JNUG, because it's levered, has time decay. And also, while I was in the trade, went from being a 3x leveraged ETF to a 2x leveraged ETF as they reverse split it. Shoot, I just moved my moving averages. Let me try to zoom in. It's like I caught basically this entire move. Yeah, this was COVID. And I'm trying to remember, I don't remember exactly where I entered. I think I entered somewhere in here in early April. And it was when we started seeing reports that Russia, this is obviously well before Russia, Ukraine and everything, that the Russian government was trying to buy up physical gold. And there was, for a period of time here after COVID, and obviously during COVID there was all types of anomalies on, commodities, especially like oil going negative. But I remember reading that Russia was trying to buy up physical gold, and that it was creating this very unusual spread between physical gold and like contract gold, basically, where physical gold was becoming worth much more than the contract, even though the contracts are supposed to be worth like physical gold. And I remember thinking that was just really, really interesting. And I was looking at this chart pattern kind of in here, and I think that's when I really started to build into it. And yeah, I think I caught like this entire move. I think I got out somewhere like at the end of July into this move. So I basically caught this entire move, and this is split adjusted from, let's call it $40 to like, I don't know, probably 160 or so, and I had size. That was really the big thing. I had size, and I was super greedy, and I like really held it, and I held through these dips. I think I even added on like some of these dips on the way up, but I held through all these dips. I held through this time correction here. I remember being, I think, a little bit annoyed in June at this low, but it filled that kind of gap down on that day. So I don't remember what the P&L swing was on the pullback, but was willing to, obviously you got extended here, right? You got extended on May 20th, then you had this pullback to a little bit of a downside extension by May 27th. So, whenever these stocks are getting extended, or whether it's JNUG or anything else, I know that has to lead to a price correction. I might have gotten out on this gap day because it was like at my target that I kind of created for myself, and it gapped up so big. I don't exactly remember. But yeah, and then I was done because I actually have always hated the gold miners, and I always thought that the JNUG, especially the junior gold miners. I remember I used to always be like, what is wrong with you if you trade the junior gold the 3x leverage junior gold miner ETF? Like what drugs are you on to trade a product like this? And then of course I ended up trading it when I was coming up with that thesis based on that news, and I thought that the technicals kind of looked right on it, and one of my least favorite products ever that I really don't ever trade anymore became maybe my best or one of my best overall trades in my career. For Michael Anthony on PED, doesn't really look like much of a mover here. PED reported earnings, which is oil, which said had 0 debt and over 30 million in cash. Okay, so just providing some information. Sure, so definitely like a lot of these oil stocks. I don't know anything about this one. This chart looks insane. I tend to shy away, which I appreciate the information because you're providing some really solid information. I tend to shy away from charts that look like this because this, to me, this looks like a company that does like almost like, I don't know anything about the company. I don't want to make any accusations, but usually when I see this type of stuff come in, it's like gives me like a very pump and dump type of feel, where they just will every once in a while rip this thing up with 100% move, only to rip it all the way back down, and I don't really know why that happens. So and it's also a little cheap for me. I think I actually may have traded this once in the past, actually, somewhere into one of these moves. But yeah, I appreciate the information. From Michael, what do you make of the USO XLE divergence, if anything? Yeah, I just think that we have consistently seen throughout this year XLE act much stronger than USO. And the reason for that is because USO is going to just move with the price of the commodity, and energy is encompassing stocks, and a lot of those stocks are value stocks. And in an environment of raising interest rates where managers want to have more, short duration assets, more value basically, they've recognized that this XLE was like a forgotten sector where you've got very low PE multiples. A lot of those companies are cash flow machines, have the ability to do buybacks, dividends, everything else, and that the managers feel the need to be able to rotate into them. So it's been really interesting to see the statistics on like how the percentage of certain sectors has changed in the S&P like over the course of this year. And I don't know those numbers off the top of my head at all, but like how energy as a percentage of the S&P has compressed. Technology as a percentage of the S&P has compressed while energy has expanded, and that's just a perfect example of the rotation from growth to value. The question is at some point do we see a little more equilibrium come in to that rotation, where instead of there being that more consistent rotation where energy outperforms, did the tide start flowing together a little bit more as the Fed approaches like a peak interest rate? I don't have the answer to that. But the answer to your question is entirely because of the value that fund managers have found in energy companies as being value names for what they're looking for right now and what they want to be invested in. Cool. All right, looks like I got through everything. See, Billy? Looks like I got through everything. That's it. Yeah, looks like I got through everything. Good questions today. Really appreciate those questions. Tom, great question. Love when you guys ask those broader technical questions so that everybody can learn. Mark, great question. Love when people ask a question about a trade that they were involved in so we can review it together as a team so that it makes everybody better. Those are all really good exercises to do. For some of you quiet folks out there, you know who you are. I know that there's a lot more people that are sitting in this virtual trading floor than those who communicate regularly. Don't be afraid to do what Tom did and to do what Mark did and put yourself out there for questions, because it's the only way that you're going to get better. If you are just in the shadows watching and, especially if you feel like you're struggling, don't expect to get better if you're not willing to, put yourself out there and ask the questions that are going to be necessary for your growth. So really good stuff, guys. Keep it coming. Have a great night, and I will see you all tomorrow.